Trading Talk Radio. I'm Ainslie Club. I'm coming from Sydney, Australia, and I have got Julian McCready from probably sunny New Zealand, because we don't get much sun here in Sydney anymore.
No, it's raining in Australia, so it has to be sunny here. That's pretty much how it works.
It's how it works, and that's what we've got. So welcome, everyone. And what we're going to do, we're going to head straight into a bit of a review for the week to see what's happening, what has happened, and then we'll go into what is coming up, because it is a pretty, I would say, a pretty busy week coming up with lots of opportunities. So let's go straight into the markets and let's have a look and see what we've got here. And we'll share that screen. Just pop you over there. Look at the euro. Look at this week. And 4 hours on my left-hand side, daily is on my right. So from this high test bar, or we call that a ringed high, the very nice little push-up on a down session, and then bang, 1, 2, 3, 4, 5, 6. It correlates directly with what was happening on the US dollar. The US dollar has been very strong this week. We had a bit of a snapback at the on the Friday session due to China alluding to a support in their economy. So we saw the US dollar get the shakes, and the world's second largest economy just starting to get a little bit of oomph behind a really sad situation with the impact of the continued lockdown, or continued COVID-affected lockdown that is really impacting all over the place. Pound, not much better. Same scenario there. We had, excuse me, we had a 17-year low there. Is that a 17-year low? I think we're seeing here. Oh, I don't think we are, actually. That's wrong. I think that was the other one. But it's just, again, a similar scenario where the pound just absolutely fell away and fell like a rock all the way down until that US dollar turned around and snapped things back up again. Dollar yen. Dollar yen. Finally. Similar scenario, but we've had it come back down. Now, dollar yen, what have we got there? We have during the week, this has hit 20-year highs at 131.25 there. So we are hitting all-time highs. It is going to consolidate. You can't keep going like that all the way straight up to the moon and back. This is not a crypto, is it, Jules? So we've got to be a little more realistic here. Oh, excuse me. Sorry about that, folks.
Bless you.
Thank you. All the excitement. So we've had quite a bit of volatility. I think you get the scenario of what's happening. We've got the dollar Swiss. I know I said you can't go straight up to the moon, but look at the dollar Swiss. It's just, let's just face it. The Swiss National Bank does not like to see a strong Swissy, and I'm not suggesting that they have been manipulating their currency at all. Would you suggest that, Julian? No.
I don't use the M word. helping their economy along. So that's what we've got. So Aussie dollar had an interesting week, by the way, because it had some very unfortunate inflation news on Thursday of last week. They didn't think the forecast was 4.9%, and it came in at 5.1%. Which, guess what? It's going to sort of affect what's going to happen on Tuesday. So what we've had here, and we'll just drop across to a US dollar chart, and you can see it going straight up, and it's had a really, really strong month for the month of April. From the 1st of April, broke that consolidation box, and it just excuse you, bless you. I know we've just got the irrits, haven't we? I've just been talking for 45 minutes, and unusually for me, I haven't been doing much talking this week, so I'm a little bit shocked. My voice is shocked, so hopefully I won't croak too much.
Sounds like it. I've just been yelling at teenage kids, so I'm pumped and ready to go. So we've got, I know the practice they give you, it's just amazing, all for free, by the way. You can see here with the US dollar, it's just taken off. It just hasn't looked back really. It's just been getting stronger and stronger and stronger, and that obviously has had a big impact on commodities. It's had a big impact on treasury bonds and real yields, and clearly on anything that's across with the US dollar on FX. So where to from here? Hey, Jules, what are your thoughts on the US dollar? Do you think we're looking for a bit more consolidation here on the US dollar, or is it just having a pause before it takes off again? The Fed's this week.
So folks, yeah, look, I'm just going to put the technicals aside for 2 seconds and think more. But Ainslie, if you wouldn't mind on the US dollar sticking a weekly chart. Oh, you got one up there on the right hand side. So for me, the absolutely key thing that's happening is the dollar should never ever be rallying. When it's rallying in the world, the US dollar is rallying. Everything else is going wrong, and we're beginning to see that. Okay, we're seeing that in some of the fundamentals, both from a political and an economic perspective around the world. I know everybody is short of staff these days, pretty much. That's a ubiquitous problem that almost every single country has. But at the same time, we're seeing a rising interest rate environment and energy prices go completely ballistic, which means that without doing anything whatsoever, the central banks are sort of walking into a recession one way or another. And they're not helping because they're starting to put up interest rates too. So for me, the key thing that has been driving the US dollar is twofold. So number one is the interest rates differentials between the US market and the predominantly European markets and some of the Asian markets as well too. And the second thing that's driving it is especially in the foreign exchange market, is the mercantilist approach that the Japanese are taking towards the Japanese yen. They're effectively devaluing it as an opportunity at this moment in time to be able to compete much more effectively with the Europeans in China. So they're having again, we don't use the M word here, but they're not disappointed about a fall in the dollar yen, which is generating that cheap currency, which means, and for those of you that follow the euro yen, maybe on the right hand side you can stick up a euro yen chart. That would be amazing there, Ainslie. For those of you that are following the euro yen, you would know that there's been a substantial rally in euro yen, which is what I'm talking about. You can see on the weekly charts there. These are not small moves. We're seeing 127 to 140 is a pretty strong move, right? That is a de facto devaluation of the yen. So two things that I'm thinking about this. I view the dollar market, if we watch very closely the interest rates, and it's not the differential that today between the interest rates of the US and Europe, it's the rate of change of that differential that decides the foreign currency exchange rates at the moment. That seems to be one of the key drivers. If the US rates, as they appear to be, are starting to slow down in terms of their ascent, they're not going higher quicker, they're going higher slower, right? If that is starting to turn down, then I think we could see a US dollar reversal. All the indicators that I have, and I use a couple of sentiment indicators and some psychology ones, are saying to me that actually we're entering an extreme on the US dollar and we're probably going to have a reversal. So I'm looking for reversals in the euro, reversals in the dollar. But again, this is reversals that you're going to see. Reversals that we're going to see. Sorry, noise going on in the background here. Reversals that we're going to see with essentially very much a technical overlay. So I think this is a short-term opportunity that might turn into a long-term opportunity, but we'll see how things get on. At some point, the war is going to end in Ukraine. At some point, the Russians will stop advancing and or the Ukrainians will defeat them. And when that happens, I think we'll see a significant turnaround in the euro. So for me, if I'm taking risk positions on over the weekend or things like that, I do not want to leave any risk positions against any of the European currencies naked essentially over the weekend, because it's 2 days where you can't trade and you might need to. So just an early warning thing for me. I think for the time being, it's pretty obvious the trend is strongly in the direction of the dollar yen, strongly in the direction of the euro, but I'm sort of not quite calling a bottom in the euro and a top in the dollar yen. What I'm really saying is here, watch out I'm not sure how short I would be here of the euro and how long I would be here of dollar yen, just because I think it's had a fantastic run.
Quite spectacular, hasn't it? I mean, you look at it,
Yeah.
it's been going, sorry, yeah. Where are we looking at? We're looking here from March.
Yeah, it's been pretty much 2 months, right? So this coincides with the end of the Chinese Olympics and the beginning of the Ukrainian war, and also with the Japanese having recognized there's an opportunity here to allow their industries to compete on a much more advantageous footing compared to their Europeans. So if you think about what the Japanese export market is like, one of their direct competitors in that export market are the Europeans, and they want to try and see if they can cheapen up their products to be able. There's not many times you get this opportunity, right? So the war in Europe has created this opportunity, and they're going to use it. So it's my view about the subject. That's not a technical market-based view. It's really just a much broader fundamental economic view. But I think that is actually driving for a change. We've got fundamentals driving the foreign exchange rates at the moment.
Yeah. Actually, did you hear yesterday that President Putin has decided he will go to the G20 summit in Bali in November? Not sure I want to be in Bali in November.
well, I suspect he might have a villa on his own.
Yeah, look, on the other side, no doubt.
Billy No Mates.
Serious? I'm sure. Anyway, he's accepted his invitation and he's off to Bali. Obviously needs a bit of sun, don't we all? However, yeah, that's 15th and 16th of November this year.
Interesting.
Like, right.
Interesting.
Okay. Where do you go to from there? But anyway, we've seen a bit of consolidation. You see it's come off its perch. But guys, you can see here going back from the technicals, you can see also from what Julian has said on the fundamentals. Look how neatly even the yen's played straight up to R2. It's taken a bounce off R2, come back down, hit previous level of resistance really neatly, bounce back up from there. And we've closed right on R1. I like it when it's really neat. It's a lovely, neat little box.
Yeah, it is. And actually, you made a good point earlier, right? When we looked at this, you said if you look at dollar yen, it's a long time since it's been at these levels. And actually, if you have the ability to put up CNY JPY, the Chinese yen, that's actually at a 40-year high at the moment. It's just come off it, but 20 is the 40-year high point. And that just really goes to show how much the Japanese currency is cheapening up against its major trading partner. And this is, I believe, the core principle behind what's going on. I think the Japanese have finally worked out they've got an opportunity here with all the chaos that is going on out there to press the advantage, and they're doing that as hard as they possibly can. So, yeah, look, it's an interesting situation, and I think it's probably going to end up continuing for some time while the Japanese hold interest rates pretty much at near zero across the curve.
Yeah. I did read that the Bank of Japan are not unhappy about this current situation with the yen at all.
Yeah, exactly. And look, folks, those of you out there who aren't following the macro environment, then just trade this technically, all right? And be aware, we're 8 weeks, in the dollar yen straight up. Okay, 8 weeks. So you go back and look at your analogs for when this has happened in the past. There aren't many. So, how long is it going to continue for? Well, who knows? Because we don't know how long things are going to continue for. But at some point, there will be a spike. There'll be a spike top, and this thing's going to reverse 3 big figures straight away. So just be aware of some of the risks that you're taking if you're going to continue with the trend here. If you have and you've got a lot of money in it, you own it from the initial breakout, then that's fantastic. Just move those stop losses up a little bit and just think about what's going to happen, because this doesn't happen very often. It's a very unusual situation. It could easily continue. The market might go to 140 as far as I know. I literally don't have any idea. But the key thing is, if it does reverse, it's going to be very violent.
Yeah, you don't want to say 250, do you?
Sorry, it's a very inside joke between Ainslie and me. I'll be right eventually, but then obviously the broken clock is always right eventually. So, yes.
I digress. But on a technical basis, it's very on on pretty much any timescale that you look at a chart, to see 8 bars up in a row or 8 bars down in a row without any kind of pullback. And this is
a weekly chart.
It's a weekly chart. So take that into consideration and just take some, just take a bearing on the fact that we've got a really, really busy week coming up. So the week coming up, RBA, Reserve Bank of Australia, it didn't have very good news on the inflation front on last Thursday. And in the April meeting, it did say that it would be, flicking over to an Aussie dollar chart, obviously, it did say it was taking a hawkish view. However, they don't, I think the word they would, if economic indicators would be leading in the fact that they needed to be less patient, they would be less patient. And the interest rates were, the inflation rate was not good. They expected 4.9. It came in at 5.1. They meet at 2:30 local time here, which is 12:30 Singapore time on Tuesday. And the market's factored in a 94% chance of an increase in the interest rates. So that's an interesting thing.
Again, just my commentary around this is there's an election coming up imminently. When is it? Is it it's a week?
21st of May.
21st of May. I think it'd be highly unusual for the central bank to be seen to be raising interest rates in the middle of the election cycle. I think that's why they're avoiding it. And look, folks, when you look at that chart, yes, it doesn't look particularly bullish. I've called it as being back to neutral. I've been a fan of the Aussie for months and months and months, and I remain a fan of the Aussie. But equally, you've got to respect the price action. So at the moment, I think you're heading back to neutral. But again, with that caveat that with a successful election, probable successful election of Morrison, although who knows, you have an opportunity for the Aussie to regain its strength. And I also suspect the RBA will raise rates quite soon after the election takes place. Yeah. So that tends to be the pattern. Very few central banks want to be seen to be influenced in the election in the middle of the cycle. So that's probably the reason why they're holding fire. And that's also probably the reason why the market came off this week, just sort of going, really? Okay, we've got to wait that long for an interest rate rise? Okay, all right, then in that case, we'll sell our positions and go put it back into US dollars.
Yeah, absolutely. And if you look on the 4-hourly chart, look at that. It's just hitting its wall, head against the brick wall on every level of support and resistance, and just not going much further. And it's 2 more weeks, and please, it's like nails down a chalkboard. It's just, there's a debate coming up. Can't wait for that. And a little bit more of kissing of the babies and flesh pressing is what I'm trying to say. Can't get that out.
As you can see, folks, from the way that Ainslie's reacting to this, you can pretty much realise that just about everybody in Australia is quite tired of the election campaign by now.
Yeah, we've got 2 more weeks to go. 3 more weeks. Good Lord. I'm trying to get it over with as much as I can. So what else we got? We've got New Zealand unemployment rates on Wednesday morning after exciting interest rates that probably won't happen. New Zealand, but the big one, what have we also got is
unemployment on Friday, isn't it?
Hey, whoa. FOMC.
Oh, really?
Yeah, that's May the 4th in the States. It's 4 a.m. Sydney time on May the 5th. So that's, in case anybody's really wanting to catch it, that's 2 a.m. on Singapore time, if you're really that keen. But yeah, so that'll be interesting, won't it? That's coming up Thursday morning.
Yeah. Well, if we do have the Fed coming out, they'll be aware of the unemployment figures that are coming out 2 days later. So I suspect very much that the Fed will be conscious of that, and if they're reasonably solid unemployment numbers, I don't think they'll hesitate in raising rates 50 basis points. I think that seems to be factored into the market at the moment.
I was going to say that's already priced in. 50 basis points are already priced in. So
But,
whether
you
it's
know, ironically with that, I would also expect to see a reaction in the interest rate markets. I could easily see those interest rate markets, the freely traded ones, actually yields coming off. So interest rates coming down slightly because they've already anticipated this to a huge degree. If you look at December Eurodollars, they're trading at 96.77, which is the equivalent of 323. So they're saying Fed funds around about 323 or 3%. And what are we now? We're at 50 basis points. So that's an awful lot of 50 basis point rate rises between now and the end of the year. Pretty much every single meeting they're raising rates 50 basis points. That's pretty crazy. And 6 months is a long way to go. Yeah, 6 months is a long way to go if the energy prices remain high. So because recession will start to hit us. So it'd be interesting to see how they how things go. That's why this is going to be such a cool year for trading, guys. You literally have come into this at one of the best trading years I think there's ever been. The interest rate market has already had its worst start to the year ever. I don't think there's any analogues that even match what we're doing now. You'd have to go back to the 1970s to find something as bad as we're seeing at the moment in terms of distant travel. So if you're the owner of a 20-year or 30-year bond, you've seen a collapse of 40%, 35% of the value of your asset. That's pretty strong. At the same time, it's hardly been a home for the stock market, which has also been struggling. So you've got all asset classes are struggling. And in the midst of all of this, the Fed is raising interest rates. It's a very interesting situation. Oh, and we have a war going on well too. So there's a lot happening. There's lots of volatility out there, lots of exciting things.
Yeah. So, guys, if you really just need to get a bit of a handle on how that on how the market is comparing to movement, just flick up on a weekly chart, and you don't normally see this kind of movement over 4 weeks. You just don't. Yeah, we've had a look on quite a few of the currencies now on what has happened on dollar yen, on Aussie dollar, and Bank of England interest rates are out on Thursday night. So that also has hit little rock bottom as well. Hasn't been down this low since July 2020. So
again, that's out of cycle for cable as well too, to be so low. So there's it's a very interesting situation. I see so many markets at extremes of movement. And that means that there's also an extreme amount of sentiment on one side of the boat. That doesn't mean to say that the market won't continue, right? Of course, it doesn't mean anything of the kind. What it is really saying, look, if this thing reverses, it's going to be really violent, and it could put a major top or bottom in place depending on which way around you're trading them, in which different market you're trading. You know, we've talked about the euro, we talked about cable, we talked about some of the interest rate markets. And they're all sitting on quite extreme readings, and I think that historic extreme readings of sentiment. So just bear that in mind. Everybody is on one side of the boat at the moment, which is the US dollar is going up forever. Just remember that. When it doesn't, who are they going to sell their positions to?
Exactly. So yeah, Bank of England again coming out. Let's see what happens there. And of course, it seems quite insignificant now. Non-farm payrolls are on Friday night.
Yeah, does anybody trade non-farm payrolls anymore?
Not anymore, not with everything else that's going on.
No, it doesn't seem to matter, does it?
It doesn't matter in the scheme of things. I mean, look what we've just run through. And as you pointed out, you know, we've got a war. We've got China in major lockdown, and that's impacting globally logistics and supply chain issues, and it's just having this knock-on effect all over the place. And it's just, where do you go to from there?
Exactly. So again, unemployment, unless it's a radically different number, isn't really that important. The interest rate announcements from the Fed are always important, so you always have to be around for those. And also, I guess, for the Bank of England and the ECB, I guess the ECB maybe next week. But if they are this week, then, you know, again, watch that one really closely as well too. I love. I have a hot cold relationship with Lagarde as a central banker, but I think actually this time around she gets it, and she's at her very best when there's a crisis. And there's a crisis in Europe, a crisis of inflation and a crisis of confidence in Europe as well too. So, and again, if you think about that more logically, if there's a complete crisis of confidence in Europe, the euro's only got down to 105. I look at that another way and go, if you roll back 25 years of the euro, it's quite, you can see situations where it got down to 67 cents against the US dollar. So why, if Europe is such a basket case, aren't we down there? And so that sort of leads you to the conclusion that actually we're not going down there. So maybe we will, maybe we won't, I don't know. But my call right now is that I think we're at an extreme. And so just be careful of that.
Yeah, I mean, let's go over to my little favorite shiny metal. Look at this week. Nightmare. Look at gold.
Hanging in. I describe it as hanging in by its fingernails. So if you put a daily chart up there, if you take that weekly chart and make it a daily chart, it just about held together the bull case, but it's very close to a breakdown.
Look, I mean, the bears, I think, are sitting there waiting. We've got a high test bar bouncing off the off the 50 EMA, but it's just hanging in. I mean, you look on the left hand side here and just look at that. Yeah, sorry. Just no. There is no setup there. Again, last week, no, just no. That's not something you can get your teeth into at all. So, and that comes back to the strength of the US dollar. It comes back to the strength of the real bond yields. It's really impacted the commodities. And obviously with China in lockdown, there is no demand.
And seasonally as well too, Ainsley. What's the seasonal pattern for gold at this time of year?
Until May.
There we go. So, guys, you've heard it from Ainsley. Okay, in terms of seasonal pattern, it's sort of like a little bit boring. For me, I sort of still have the faint hint of a bull case in there, but I'm being questioned every single time I look at these charts. So I can see things that are happening, and I'm itching to trade, but I'm not trading at the moment because I'm itching to trade. And normally, when that happens, that means I'm a little early. So I'm just holding fire.
And even the black number, the black shiny stuff. It also and now we've got OPEC Plus coming up this week as well, and on top of everything else, on top of a fairly dull week on the news front, we've got OPEC Plus. Now, market is actually expecting OPEC Plus just to rubber stamp that 432,000 barrels a day, but even looking at this, by the way, we had this bit of a run up because it was announced a little bit earlier on. Russia is down $1 million a barrel per day on the supply side of things. So that has pushed up there. Also that happened on Friday was an announcement by the US government, because the US market, so the little boys down in Houston who've been drilling their oil, have been price gouging and racketeering and profiteering, and they're actually getting called to Washington with a please explain. So that had a little bit of an impact on the market, but the whole Libya has we discussed this several weeks ago. It's got some civil unrest. It's just in this consolidation phase because it's not too sure what it's meant to be doing at the moment. Russia down 1 million barrels a day, and they were whinging and bitching only 12 months ago that they could only increase their production of 400,000 barrels in total a day. And it's just like, hey, guys, you're down 1 million because, oh, no, they're a little bit distracted doing housekeeping.
Yeah, actually, so I can have a fairly... I can have a crack at explaining why they're only, well, actually, in some cases, they're only down 1 million barrels a day. So 2 reasons. Number one, India is buying a lot of their oil.
Yes.
So, and if you think about the problem, right, with the initial move up in the oil market, it was Russian supply leaves the market. Well, actually, number one, it hasn't left the market. It's just been diverted to other places. So, yes, they're not sending any to the West at the moment, but the Indians seems very comfortable buying Russian oil at a big discount. Secondly, there will be a loss of production because if you think that some of the Europeans aren't paying their gas bills, apparently, or they refuse to pay them in rubles. What happens when you have an oil field? You don't just make oil out of it. What happens? You make a whole series of different products, and oil is one of them. The other distillate products that come out of the field includes gas as well too. And so if you have a field which is constrained in terms of the gas supply simply because the pipelines are full or people aren't paying their bills, then you can't pump as much oil. You literally have to switch everything off, so it all comes out the ground together. So I'm not surprised that Russians' the production volume is down. I don't think there's a problem with the plant or anything. I think it's just the fact that there's a constrained supply of gas going to Europe, so they just can't. To start off with, you sort of put it in tanks, and at some point you top off all the tanks, and then you go, well, what do we do with it now? Well, we have to stop pulling it out the ground. So you then stop doing that, and that reduces your oil supply as well too. There'll still be some coming out, but not as much as you'd like. So I think within that, you actually create a really weird circular function whereby if you reduce the flow of gas, you also reduce the flow of oil as well too. So then you can create, if you like, you can create a Twitter storm around a shortage quite easily, but it's pretty much down to the fact that Europeans aren't paying their gas bills at the moment.
Well, it doesn't help that Mr. Putin decided to restrict gas supply to Poland and Bulgaria at the same time.
Yeah, exactly. So again, crazy times. But Ainsley's right. There's lots and lots coming out this week, guys. Good fun with the trading.
Oh, speaking of Twitter, and here's a chart on the S&P. Hello, was that a solid hello back down again?
Yeah, guys, so if you see just right behind me, on the top left-hand side of the screen, there's something called the overt warning and the subtle warning. I'm beginning to worry that we've just passed the overt warning phase and we're beginning a decline. But if you think about this holistically, with all the stuff that's going on, only being down 10% for the year for the S&P is actually spectacular. You'd have thought it would be down an awful lot more. I know the Nasdaq is suffering, and for those of you that have lots of jam tomorrow Nasdaq stocks, you'll know exactly what I mean, because some of them are down much more than just 10 or 20%. Some of them are down 70 or 80%. But the overall S&P hasn't really shown a huge weakness yet, and I find that actually quite remarkable. I don't have anything to add to that. I'm in sell rally mode on the S&P, and I think that's pretty much how I'm operating. I think other parts of the other sectors of the US stock market are more interesting other than the S&P. Some are doing really well. Energy is holding up really well. Some are doing terribly. Some of the tech sectors are being destroyed. So there's a lot going on when you look under the hood. But right now, S&P down this much, how odd.
Despite being able to tweet at your own own expense or on your own time. But let's just have a quick look at the technicals. Here we've got that high test bar bouncing off the 50 EMA, and down she came. So for anybody who's any of our newer traders looking for that high test bar after a run up on a trend up, high test bar bouncing off a level. Now it was not only the 50 EMA, it was a strong level of resistance that had previously been support, and down it came. So that's a basic technical setup. Here on the daily, we saw a huge, really strong reversal bar of an engulfing bar. It engulfed the last couple of bullish bars. Bull bars are on a ute. And down she came again. So looking for your technicals that actually support look, Julian, you do it as well. We both trade technicals, and we both rationalize and analyze what we're doing with what's happening fundamentally and geopolitically as well. So when you see those kind of setups, don't ignore them. They're there for a reason.
Yeah, you're exactly right, Ainsley. Look, I think, again, if you think about in terms of the sentiment cycle, folks, the stuff behind me, this works in short as well as medium and long-term timeframes. And what we're seeing at the moment on the long-term timeframe is a small movement down. We haven't really seen any substantial damage to the US stock market. In actual fact, if you go around to other stock markets of the world, they're also all trading at relatively good, strong levels, which reflects an underlying confidence in the economic situation. So then you say, well, okay, is that underlying confidence or is it over exuberance? And that's the question that we all have to ask ourselves. So this is why some days trading can get a little hard. But when you look at it in terms of sentiment cycle, one thing for sure that we're not in right now is an oversold market.
No, I think it's on its way down. But, look at the FTSE.
Yeah, it's almost, how far away from all-time highs? Right, so that that sort of rests my case, really.
Yeah. Not
So
far. But that's what we've got. So this week, a lot of, I think we just need to be very careful. You've got a lot of volatility. You've got a lot of economic data coming out that if it hits predictable levels and it's priced in and it's expected, there's not quite so much movement. However, where you have huge movements in the market is when the numbers and the figures of the economic data come out and don't meet what is forecast, and there is an unexpected reaction that will be something that can be traded. So either way, anybody who's trading, any of our newer traders, please be careful. Make sure you got your, everybody should have their stop losses in place, shouldn't they? But be careful. A lot happening, a lot of volatility, and that means a lot of opportunities as well. Just be careful. So on that note, I think we can wrap it up. Have you got anything more, Julian?
No, that's all from me.
Great. Well, thanks everyone. Thanks for joining us. Happy trading. Enjoy those setups and keep your helmets on. Okay. Mai, thanks very much for attending and assisting us tonight. And on that note, have a great week. Bye, everyone.